So we are always interested to see how mutual funds are performing because mutual fund has a major role as an institutional investor in the financial market and both capital and money market. And in previous session, what we have seen that how mutual fund actually perform or how they are doing, whether they are able to generate the alpha for their investors before expenses or after expenses. But what we have found in the study, just for recalling, that though mutual funds are performing well in terms of generating alpha without considering the expenses, but when we are considering the expenses, we see on an average their performance goes negative uh, when we consider the expenses. I mean the post expenses, their performance is not satisfactory. Their performance becomes negative. So as an investor, always we need to check that how mutual fund performs after expenses. So we also have discussed about the timing ability, that uh, is it possible or whether mutual fund managers are skilled enough to time a particular factor which is going to uh, play role in achieving the performance in coming days. So we gave example for that, but in literature it has been found that in most of the cases they have found that mutual fund has timing ability, and in several cases authors concluded that mutual funds do not have the timing ability, so they cannot able to time the factor which is going to uh, give higher return in coming days. So we have talked about several factors. The factors can be market factor, which is commonly known as market beta, or it can be size, it can be value beta, or it can be momentum, or it can be kind of in behavioral aspect, it can be sentiment, these things. Or you can think of beta with say when the technological stocks boomed in late 1990s. So which funds are expected to outperform? The funds which invested heavily in tech stocks, and at the same time they also knew very well that when this boom will, or when this bubble will burst, so they took decisions properly to close out their position before the burst of the tech bubble. So that is the way how mutual funds want to time their investment. So in addition to the timing result, that whether mutual funds have the timing ability or not, there are uh, very narrow results for the bond funds, which are our right interest in this session, or we are discussing about this in previous session. So we see bond funds are underperforming relative to their benchmark, and if we consider the benchmark, appropriate benchmark for the bond funds, we see that mutual funds are bond mutual funds which invested primarily in bonds, which can include government, corporate, municipal bonds, and their performance is negative. So we see that managers are not smarter as expected, and managers are underperforming relative to the benchmark, which have been used to measure the alpha. So it was part of our previous discussion, but the topic in which we are interested today, that is the persistence of mutual fund performance, which is also interest of many of you. The idea is that when we go for buying a mutual fund unit, we are primarily interested to see, or one of the factors in which we try to concentrate, that how this fund has performed in previous years or previous days or in current year. And if we see what investors commonly do, if investors see that this mutual fund are performing well nowadays, and these mutual funds have also performed in previous years, so that these mutual funds will be good investment for future. So that's why investors have a tendency to pick the funds which performed well in earlier days. So the question is, does the mutual fund which perform well in earlier years can also perform or outperform in future days? If we see the mutual funds which performed earlier, which outperformed earlier, they also outperform in future years. And at the same time, if we see that the mutual funds which underperform in previous years and also underperform in future years, in that case, we see or we conclude that their performance has persistence. Their performance has persistence. So for that reason, investors have a tendency to buy the funds which performed well in previous years. And investors also have a tendency to avoid those funds which didn't perform well in previous years or which underperformed in previous years. So the question is, uh, if the fund, or which is our interest area, that is the performance of active fund, or we are more interested about the performance of active funds because the alpha is more relevant, or alpha is particularly relevant for active funds, not for passive funds. So if we see that active funds are outperforming the passive funds, we need to understand that managers are doing something good for the investors, and managers has the ability to add value for the investors. But at the same time, you know very well that uh, these active funds charges more from the investors because they make investment actively, and they do their own research, and they have to spend more time and energy effort for analyzing the stocks to be included in their portfolio. So that's why their charges are expected to be higher for investors compared to the charges charged by the passive funds to the investors. So if it has been found, uh, say the alpha which have been earned by active funds gets negative after considering the expense ratio or expenses charged by the active fund managers, in that case, uh, we need to understand that managers are not adding value for the investors, because after considering the expenses, I'm getting negative, or uh, I'm not getting the expected return what I expected to achieve. So that's why we need to think of the post expenses alpha. So we are interested about the expense ratio. So this expense ratio measures what? This expense ratio measures the part of operating expenses what investor pays to the mutual fund when they make investment with them relative to their investment. Say for example, if I go for making investment of 1000 taka, I have to bear 10 taka operating expense In that case, what is my expense ratio? What is the expense ratio for investing with this fund? Is it 1% or very less than 1%?
1%, sir.
Is it 1%? Right?
Yes, sir.
Okay, it is 1%. So usually it is less than 1%. Just for giving you some example, I'm taking a number, but the ratio which is expected to see, or you will see this expense ratio, what investors incur is less than 1%. It's 2.2, 2.6%, or 0.3 to 0.7% in these ranges. So the thing is that whether there has been any evidence that the mutual fund which performed well in previous years and also perform well in future years, and at the same time whether there has been evidence that the mutual fund which performed poorly in previous years, they also perform uh, underperform in the coming years or in the future years. So let's look at some findings of the research that the several research findings have been summarized here. So we are particularly interested with the papers which used alpha as a measure of performance, but before uh, discovering the alpha measure, the authors used to consider the return as the performance measure of for the mutual fund. So we have talked about alpha, that how alpha is measured from single index benchmark and multi-index benchmark. Can you recall? This is for single index where we just have included the market return. And now if we included, for example, size beta, and we include the return for size factor, and if we include the value beta, and we also see the return for value, and which additional factor Carhart assumes in multi-index benchmark. Can you recall?
Momentum factor.
Momentum. So this is the excess return always. You see, this is the excess return. We are always interested with the risk premium, not only the return. You see the return name only. So actually these are not the this number. Actually these are the excess return or return over the risk-free rate. So if we also take the momentum beta here, okay, so momentum, okay. So the thing is that uh, we are right when we are seeing the alpha, for example, 4-factor alpha. Is it the 4-factor alpha if we measure? Because we have taken how many factors here?
4 factors.
4 factors. So if you are interested to evaluate the performance of the equity mutual funds, it is very global standard to use the Carhart 4-factor model. So who has popularized this measure of performance? 4-factor alpha, the Carhart. If you ignore, so what is the contribution of Carhart? Carhart contribution is to add the momentum factor, this momentum factor, okay? But the thing is that momentum has not been discovered by Carhart. Momentum has been discovered by Jagdish and Titman paper, or the authors. And these factors, size factor, value factor, in addition to the market return, who have introduced or who have come up with these factors, size factor and value factor?
Form of range.
Farmer friends, thank you. So when we are talking about the four factor alpha, we are talking about this alpha, where we have considered these four systematic factors for which any investor should receive compensation, or any investor should get a risk factor for assuming this systematic risk, and for assuming this risk factor in his investment. So what has been observed, that these are different ranking measures what they have used, and these are the evaluation measures. And what is the ranking measure? Ranking measure means, say you want to rank the funds which are top performing and which are bottom in the performance. So how they have ranked this paper, or these authors have ranked based on this measure, and GNT measure are based on the author's own name. So it is not popular nowadays. The one which is popular, that is the alpha, and alpha is continuously investigated by the authors in the finance, that which alpha is more relevant for measuring the performance. And right now in equity mutual fund, say for example in our country, we do not have the bond funds uh, specifically, though some funds have very small investment in a bond. But the thing is that we do not have the bond funds. So in bond funds, which is more popular, the fund which has been popularized by these authors, Alton, Gruber, and Blake. Can you recall you read about a paper which I shared in classroom? You saw that they have used three index benchmark, three index alpha, and in another model they have used 6 indexes in measuring the performance of bond funds. We discussed in previous class, or the class before the previous class. Can we recall that they have used some factors relevant for bond funds? So for relevance with bond funds, which is used by them, or which is available from their paper, that is they have taken, for example, this return. What is this return? This return is the excess market return, right? Though I have written here RM, it is not the market return, it is the excess market return. Okay. And instead of the size factor here, they have taken the return from the bond market. Return from the bond market. And it is the return from the excess return from the stock market. And it is the return from the excess return from the bond market. So can you tell me some indexes which are used in measuring the stock market return across the country or globally? Which indexes are more popular to measure the market return? In our country, we now use the DSEX, so which is used in US market for the stock market return. Are you familiar with the stock market index return, or stock market indexes which are commonly cited in the newspaper to show how the stock market is performing? Which index is taken as a proxy to measure the stock market return?
S&P 500.
Yeah, S&P 500 is very common, and commonly used in academic research also to proxy this market return. And there is another return, another market return, that is CRSP value weighted index. CRSP value weighted index. And CRSP, I talked about, or I shared about CRSP to you in earlier class. CRSP value weighted index is also used in academic papers to measure the market return. And for bond return, there is also indexes available for provided by CRSP. So it reflects the bond market performance. And the value premium or the momentum premium have not been found in the bond market return papers or bond market performance papers, which have been made popular. Is there anyone who has gone through the Pharma Friends seminal papers, common risk factors in the stock and bond return? I mean the 1993 paper. Anyone? Which has given us these three factors, what I wrote earlier, the size value factor, common risk, cross section of stock, cross section of return. Or have you ever opened the file that Hoyer Pharma Friends has introduced the factors what they discovered? Anyone? These are the some papers what every finance person should go through or should have a look at least. I mean, the paper right now I'm asking from you common risk factors in the return on a stock and bond. Yes or no, simply.
No, sir.
There is no penalty for that. So just yes or no. Okay. So the paper is common risk factors in the returns on stocks and bonds, which has given us these three seminal factors or three popular factors what we use nowadays in measuring the stock performance or measuring the fund performance. Okay. So we are agreed that single index benchmark or single index model uh, single index model is not appropriate for measuring the fund performance. You already have come to learn because there has been some constituents in the portfolio which do not which are not reflected by the of which return are not reflected by the return of the market index. So we are we agree on the notion that we will try to use the multi-index benchmark. So Pharma Friends has given us the two factors in addition to the market factor. So that is the very beginning of the multi-index benchmark. So in this paper, Pharma Friends 1993, for stocks and also for bonds, they have used in total 5 factors. So let me write down the factors. Market. So it is the excess market return. Then for the size, value, and for bonds, you would see that they have used the two additional factors, term and default. So assuming these factors should provide investors compensation or should provide investors return for assuming risk for these factors. So uh, you already have come to learn that small companies give higher return. Small companies give higher risk premium because their risk is higher, and the high value stocks, between high value stocks and low value stocks, high value stocks give higher risk premium, which is known as value premium, because they are undervalued by the market participants. And in addition to these factors, when we are interested with the bonds, we uh, get these two factors, additional factors for bond. One is term, another one is default. So between two bonds, one bond has 1 year maturity, another bond has 10 years maturity, and other things, for example, same. And what do you expect? In which case, you should expect higher return for 1 year bond or 10 years bond?
10 years ones.
10 years bond. So why you are expecting higher return for 10 years bond? Because this term is longer.
Yes.
Because of its term is longer. And if I talk about two other bond, one bond is say has rating of triple A, and another bond has rating of double B. So for which bond you should expect higher return, triple A or double B?
Triple A.
Think twice.
So double B, as risk
For
is higher.
double B, you should expect higher return because you are assuming more risk for investing in this bond. Okay, so that's why this default risk factor has been added, and it has been found that these two factors uh, explain return, additional return, which cannot be explained solely by the market return. So that's why they suggested for adding these two factors when we consider the bond investment. So later, when the mutual fund performance or mutual fund researches were done, researchers started using these factors to estimate the alpha. So if I continue to use this pharma friends term and default factors, which additional two factors I have to add here? One is for return for term factor, another one is return for default factor. And uh, here is the beta for default factor, and here is the beta for term factor. Now you see that if the term factor gives higher return, and which bond is expected, which fund is expected to generate higher return? The fund which have higher beta in the term factor, or the bond or the fund which have lower beta in the term factor? If the return on term factor is expected to be higher in coming days, which bond fund is expected to outperform or expected to give generate higher return, higher total return? I'm not asking for alpha. I'm just asking for in terms of total return or risk premium, which bond is expected to get higher return? The fund which invests at, or the fund which has higher risk exposure to the term factor, or the fund which has low exposure to the term factor? Are you getting? If the term risk premium is expected to move in this way, which fund is expected to outperform? The fund which has higher beta in this term factor? So that is very intuitive. You can confirm from other papers. Okay, let's continue. So what we are discussing that these are the factors if you use the Pharma Friends paper, but if you use the uh, Alton Gray, Groover, and Blake paper or their models, which multi-index benchmark they took, uh, they took the return from a stock market or excess return from a stock market. Very specifically, I should be very specific here, otherwise you will get confused. Excess return from the bond market, and they also have taken uh, default premium here. Default premium, you see the beta for default and return for default factor, and they have also taken the option factor. Have you heard about Ginima in your financial markets institution course? Have you heard about financial derivative securities? Derivative securities, there are some securities which are derivative securities. Have you heard about derivative securities?
Yes, sir.
Okay, so it has been observed that some funds portfolio include derivative securities. So there is no risk factor which reflects the return on the derivative securities. So which factor they took to reflect the return which is expected to earn for what purpose? Because the portfolio has included some option securities or derivative securities or Ginima securities. Okay, so you will come to know about it. You should come to know about it from your financial markets institution. Okay, so if you see this paper or your text we discussed in the class before the previous class probably, and I also shared a paper, you would see these factors have been used by these authors. Okay, okay, so let's continue our discussion. We just have understood that how alpha is measured and how ranking is done based on alpha and how evaluation is done. So evaluation of performance is done based on this, and ranking has been measured based on these factors. So if I rank funds based on alpha, which fund should be in the top quintile and which fund should include in the bottom quintile? The funds which have the highest alpha, say I have classified the sample into 10 groups. Will it be a quartile or decile? Each of this group will be known as now decile.
Yes, sir.
You learned about decile from your state, basic state. Okay, so the top funds which outperform the top decile, I mean this decile includes those funds which have the highest alpha, and the bottom basket includes or bottom decile includes which fund which have the lowest alpha. So the findings of the paper have been summarized in the third column. You see, most of the papers have concluded that there has been performance persistence in the performance of the mutual fund. What do they indicate? If there is performance persistence, the future performance is predicted by the past performance. So, for example, if we rank in this way, that bottom decile includes the fund which have the lowest alpha, and top decile includes the fund which has the highest alpha in the previous year. Okay, so if there is persistence, which is likely that bottom decile or the funds which were in the bottom decile for previous year will continue to underperform or will continue to perform poorly, and the funds which performed well or outperformed in the previous year will continue to outperform. I already have mentioned the concept of persistence. So when they have concluded that there is a persistence, what does it indicate? It indicates that if the funds perform poorly in the previous year, it has been found that they also perform poorly in the future year. And if it has been found the funds which perform very well in previous year, they also perform well in the future. So, and in the last column, what does it indicate? It indicates that can you recall that in this chart, we saw that most of the funds underperform? Can you recall this? Most of the funds underperform, equity funds,
Yes, sir.
negative. Okay, only this is the positive. Okay, that is exceptional. Okay, so here we are indicating that the top funds in this paper, they have found that top funds, obviously it can happen like this. For example, it is -9. I'm just -9 will be a very big number. Okay, say -2, -1, then -0.5, -0.25. Top decile can also report the average performance like 0.25% negative. Though this top decile is showing negative performance relative to other decile, this performance is better.
Yes, sir.
This performance is better. So which one is more better? If this performance is positive, it is their average performance is in top decile, and at the same time their average performance was also positive. It is more better than the previous case.
Yes, sir.
So these papers have found that top group means here top decile reported positive alpha, but this paper reports top decile reports negative alpha. Okay, so what we have found that uh, mutual fund performance has persistence. So now what is the takeaway from our discussion? That if you buy a fund which has performed well in recent years, you should expect the fund will continue to outperform in future years. So if investors do check the alpha of previous years for the funds and decide that I should pick these particular funds because they performed well in terms of alpha in previous years, investors should expect that these funds, what they have selected, they will also outperform in future years. So it is one of the findings of one of the papers. What has been observed, which I already have gave an idea in previous slide that in previous year, based on previous year's alpha, if you rank the group of funds in this way, this one includes the bottom, this one includes the top in terms of performance. And in future years, it has been found that the funds which were in bottom decile in based on their ranking in previous years, their performance is poorer relative to the performance of the funds which included in the top decile in the previous year based on their rank in terms of alpha. So you see it's much significant. You see it's more than 2% or more than 2.5%. This is 3% actually. And you see this correlation, Spearman correlation. So there are several correlation measures. The correlation measures what we commonly use in applied statistics, that is the Pearson correlation matrix. So this correlation which has been used here is Spearman correlation. And you see the p-value for the correlation is significant at 1%.
Yes, sir.
So this is,
0.1%.
yeah. So which one should be, it should be dependent variable, it should be independent variable simply. If we want to test the persistence, do the previous history predict the future alpha? In that case, which one should be independent, one should be dependent variable? This realized alpha in the future year should be dependent, and the previous year ranking should be independent. Okay, so they have found that the correlation is statistically significant at 1%. So what you have learned that the funds which performed earlier, performed well in earlier years, they will perform well in the future years. So the thing is that the authors conclude that, or the authors are arguing that the papers which reported that there has been persistence in performance, we do not know which alpha they have used. You see, do we have indication which alpha they have used? But here we see they have used the 4-factor alpha, 3-factor alpha. Okay, now you see, can you recall the Jensen alpha you learned in portfolio management class? Jensen alpha measure. Can you recall Jensen alpha measure?
Yes, sir.
Okay, so Jensen alpha use how many factors to estimate the alpha?
Sir, I think only one factor, market factor.
Only one factor, excess market return. Okay, so I'm confident that these two papers, which are very recent papers, didn't use the single index model, but these papers, okay, we do not have the clear indication. But what I have trying to argue that based on the author's conclusion that the papers which found strong evidence that there has been persistence in the performance of the funds, they are more likely to use the single index model. That's why they reported positive alpha, or they reported significant alpha. So, but if they are using multi-index benchmark, they would not get the persistence in the performance. So just for recalling what we discussed earlier also, say a fund is getting higher return for investing heavily in the small sized companies. So in that case, what do you expect? This single index model where only excess market return is used as risk factor, or market risk factor is only used as a factor, excess market return. Does this model account for size premium? Does this model, if we use this, just what I wrote here, the Jensen alpha here, does this model account for size premium?
No, sir.
So in that case, what do you expect? If the fund really perform well for investing intensively in the small sized companies, and you are using the Jensen alpha, do you expect this beta will explain much of your return? This beta will not explain much of your return, which is due to the factor, size factor. In that case, what is expected? You will see that alpha has become a big number. Alpha has become alpha has been calculated as a big number. For what reason? Because you have missed out some factors here which are relevant for measuring the performance of this fund, or for measuring the alpha of this mutual fund. In that case, what is expected? This alpha should be a bigger number. But if you use the multi-index benchmark, where you have included the size factor also, RS, size factor premium, okay? In that case, you should not expect a significant alpha. Why you shouldn't expect significant alpha? Because Pharma Friends has found that most of the returns, a significant percentage of this risk premium can be explained by size factor and the value factor, in addition to the market factor. In that case, if you are getting significant alpha by using this factor only, it is expected that you have missed some factors which are relevant for measuring the alpha of this fund. But when you use the multi-index benchmark, which is relevant or which is always recommended, in that case, remember, it is for active funds, not for passive funds. In that case, what is expected? The alpha is expected to be insignificant. So it is against the findings of the paper, which concluded that there persistence has been found in the performance of the mutual fund. Okay, so let me relate. Say Pharma French took the data from the year 1926. So they published their paper 1993. So for long years, they have found that small companies give higher return relative to bigger companies, and high value companies, high value means high book to market value companies give higher return relative to the low book to value companies. So if someone ignores this size and value factor, but they have found that size factor has been giving a significant risk premium and value factor has been given significant risk premium. But in our country, what do we use? We simply use the DSE X market return, and we try, or mutual fund managers also try to compare their fund performance directly with the market return in this way. This is the fund return and this is the market return minus the risk-free rate, and they continue to use the single index benchmark. They do not use the size factor premium, they do not use the value factor premium, or they do not go for calculating this to estimate their alpha. So if they really calculated their alpha based on considering this this factor, this factor, this factor, they, it is expected that their alpha would be insignificant, or their alpha would not be very big number or very close to zero. But if you continue to ignore this, what is expected? What you will find? You will find that this alpha is a bigger number. This alpha is a bigger number, and managers want to give credit to themselves that this alpha has become a bigger number because we are the people who worked behind this fund. So actually, Pharma discovered that this is not, or these authors have discovered that sometimes managers skip these additional risk factors which are necessary to measure the true alpha of the fund, and they give themselves credit for higher alpha. Actually, this alpha has become higher for what reason? Because we have skipped some risk factor for which risk premium has been available. Have you got it? So that you can continue. Yes, no?
Yes, sir.
Okay, so we have found that future performance can be predicted by the past performance if we believe that there has been, or if there has been evidence that there is a performance persistence. So if the performance gets higher for a fund, what do you expect for the size of the fund over time? What do you expect if a particular fund, say particular fund A is outperforming other funds B, C, D. This fund is particularly outperforming these funds continuously. What is expected to happen to the size of this fund? What do you expect? All people will rush after this fund? don't relate it with the closed-end fund where the fund cannot accept the fresh investment. Relate it with the open-end fund. What do you expect? People will go after the honey? Yes, no? People will go after BCD or people will go after A? Am I clear to you, or I should you want me to repeat the question? If the fund A outperforms relative to other funds B, C, D, what is expected to happen in the fund size of A?
It will increase.
It will go up because people will make crowd in this fund by
Yes.
withdrawing fund from here and injecting fund here, right? Okay. Now if the fund size grows because people have crowded here, now what do you expect that what will happen, or what do you expect that what will be its future performance look like? Its future performance will be more higher or more outperforming, or it may decline? What do you expect in terms of performance if
It may
size
decline.
grows? Decline. Just give me the answer. What will
Yes, sir.
happen to the performance and what will happen to the cost of the fund? What do you expect? Decline for this performance, right? Or it will improve?
Yes, sir.
Okay. Can
Yes,
you
sir.
tell me the reason why you are expecting that the performance will decline when the size of the fund will be bigger? Okay, before that, just like to ask a GK from
I
you.
think, sir, size premium will go down. Size premium will go down.
It is not the size what we discussed in the size factor. Remember, we talked about size, value, market risk, or market factor in the Pharma Friends 3 factors. It is not that size. This size is of the company size, market capitalization, market cap. Okay, and here we are discussing asset under management size of the fund. It is of the size of the holding stocks or holding companies by this fund. And now here the size means the mutual fund size, which is measured by the asset under management. Have you been able to separate these two out? Have you been able to separate these two out? That these two sizes are not same. These two concepts are not same. Here we are interested about the size of the companies in terms of market capitalization. These companies are included in the portfolio of the mutual fund, and here the size what I just have mentioned, it is the size of the mutual fund based on the asset under management, AUM. Now tell me, can you just expect something that why you what kind of relation you expect that if the fund size has gone up, what do you expect for the cost of the fund, and for what do you expect for the performance of the fund? Will the relation be positive, negative, or there should be no relationship? Saurabh, you there? Akash,
Yes, sir.
what do you expect that if the fund size gets bigger, what do you expect for the upcoming performance or the future performance of that fund? Okay, before that, I just like to ask, which fund has the highest investment in our market in terms of mutual fund? Which fund is the largest? I'm interested about the open-end fund. Okay, skip that GK. Just what do you expect? If the size of the fund goes higher, what do you expect for the future performance of the fund?
Performance, sir, might go down.
Why? Uh, just try to share your intuition of how you have come up with this conclusion, or why you are expecting so. Any guess? Any guess from you? Okay, this paper is interesting paper, a flow-based explanation for return predictability. So when the flow gets higher in a particular fund or in some funds, what is expected to happen? So they have found that in recent years, I mean, say for example, in 20, right now we are in 2021, in 2022, you would see the fund performance has got higher, but in later years, you would see that the performance is expected to decline and the performance reversed. So we will try to see that how the size of the fund influence the performance and the cost and how they are related. So it has been argued that, or in some papers, there are mixed findings that if the flow goes up to a particular fund, or if the flow goes up to some funds, they are expected to outperform or underperform. Okay, so there has been some mixed findings. So there are some reasons which have been discovered that if the fund size goes higher, so remember what I am trying to highlight, fund size is measured in terms of asset under management. So when asset under management goes up, when the flow goes up, When the flow goes up, asset under management goes up. So when the flow goes up, when the fund performance goes up, when the fund past performance goes up, people crowd after this fund. People tend to take out their flow from underperforming fund to this outperforming fund, and the asset under management of the fund goes up. So the question is now, what will happen to the performance in future? Say it is the performance of the past and it is the performance of the future. Now, what do you expect? What is going to happen if the fund size goes higher? So fund size is measured usually by the asset under management. So it has been suggested that there might be a decline in the performance. There might be increase of the performance, or the evidence is mixed, but sometimes it varies. So cost might go up, some cost may go up, then performance may go down for increase in the size of the fund. So what may be the potential reason? Cost may go up or the performance may go down. Sometimes some costs are also go down. So there are mixed reasons, and the issue is how you want to relate. So can you recall in the introduction of today's session, I mentioned about the expense ratio?
Yes, sir.
What I have mentioned, the amount of expense of operating expense, what investor incurs for making investment in fund. Okay. So what kind of costs are included in this expense ratio? It is usually expressed in terms of investment expense, operating expense divided by the investment of the investors. Okay, so usually this expense ratio has some component, and the two broad component are, one is administrative cost, another one cost is management fee. So what do you expect in administrative fees? There should be a high variable component or high fixed component in administrative fees or in administrative cost of the fund. I mean, there is a AMC behind every fund. Can you recall the AMC? Agro Marketing Company. Can you recall the AMC we discussed in the very first class of this course? Or we have forgot everything? Tripti, can you recall that what we meant by AMC? You are there, Tripti?
Yes, sir.
Yeah. Can you recall that what we meant by AMC?
No, sir.
Okay, asset management company. Asset management company. Now you can recall that we talked about it in the very first class of this course.
Yes, sir.
Okay. Okay. So the thing is that for administrative cost, the fixed portion is a bigger. The fixed portion is a bigger. So if I just try to relate, other costs are same. What will happen if the fund size gets bigger? What is expected to happen to the expense ratio if the administrative cost is a major component and the major component of the administrative cost is also fixed? What is expected to happen? Expense ratio will come down. It is the advantage of economies of scale.
Yes, sir.
Okay. But at the same time, you see the management fees. Management fees has usually two components. So one is usually based on their asset under management, which is a percentage figure that if you say, for example, if you manage 1% of the 1 million, just think of 1% or 2% of the asset under management. So if your fund management is 200 million, how much management fees you want to expect? That is a very big number, 2% of 200 million taka. What do you think? It is a very big number.
Yes, sir.
2% of 200 million. Okay. And another component of the management fees is based on the return or based on the outperformance they have achieved. So say they are given some target, so that if you can cross this hurdle rate, I will give you this percentage or this amount. So that is variable based on the performance, based on the pure performance or pure outperformance. But this amount is correlated with asset under management, or this amount is heavily dependent on the asset under management. So if your fees as a manager is related to asset under management, what will be your target? To take the number to a big number or to reduce this number?
Big number.
To increase this number. Okay. So when you increase this asset under management fee, when you increase this asset under management firm, now the asset management company investors are now giving more fees to the managers, because the size of the fund is a bigger number. Now managers are getting more compared to previous. Do you think it should look like in this way? Managers will get higher fees when the size of the fund goes up.
Yes, sir.
But if you visit the asset management companies mutual fund guidelines or the mutual fund prospectus, you'd see they mention that, for example, if my fund size becomes greater than 500 million, this asset under management fee will no longer be 2%, it will come down to 1% of the asset under management. It is for what purpose? It is for reducing the expense. It is for reducing the expense in terms of management fees by the investors. But do you think management will be very flexible to make you implement this policy? Do you believe that managers will be very flexible to make you changes in their fee percentage from 2% to 1% when the fund size goes beyond 500 million? Will it be very easier for the investors? Yes, no? This will not be very convenient for the investors to make the managers agree that now you have to take 1% of the asset under management, and I will not give you, or will not give you 2% of the asset under management as you are taking earlier. So the thing is that, but if you want to relate these expenses with the size of the fund, all the expenses, if you want to relate the expenses with the size, you will see that this expense ratio is expected to come down when the size of the firm goes bigger. So if the expense ratio goes down, what do you expect for the investors post expense alpha? It is for the economies of scale. Why should expense ratio come down when the size gets bigger? It is for the economies of scale, and you have to think of the cost separately. Okay. Now, what will happen to the post expense alpha? If the expense ratio goes down when the size of the fund goes higher, it should improve or it should disprove?
Sir, it should improve.
It should improve. Okay. Now, can you recall from your microeconomics that economies of scale has a limit? Can you recall from your microeconomics learning that microeconomics 101 that there is a concept which is called diseconomies of scale?
Yes,
Yes,
sir.
sir.
Okay. So it is not necessarily that the size of the fund goes bigger, bigger, bigger every day, and the size will come down in this way. Size may go up after a certain point of time. In that case, what is expected? The post expense alpha is expected to come down. And for example, you are a fund manager. In 2019, 20, when the Bangladesh market didn't do very well during this period compared to recent months. What mutual funds did? Mutual funds were able to invest in many undervalued stocks. Is it true? Say, for example, in that time, the GP was trading at 237 for long months, for several months, 237.5. Was it a good investment compared to current price? Now it is trading at 346. Yes, no, very straightforward question. These are not very question which will require you to think for 1 hour, then you will give the answer. Is there any marginal cost for giving the answer? I should believe that someone is there so that I am talking with someone and having the class. Partho? Partho, you are there? Partho is not there. Nusrat,
Yes, sir.
you are there?
Yes, sir.
Okay. You see that in 2019, when the market was not doing good, GP was trading at 237.5. Would it be a good investment for the mutual funds to buy at that time and to hold that stock, hold this stock at this current price?
Yes, sir.
Okay. In that case, you will see that the NAP reported by the fund in that time. Now, if you compare the NAP with the NAP of the current time, it will be a bigger number and you will see a good return over time.
Yes, sir.
Okay. Now, what will be the tendency of the investors to pour money in this fund now?
Sorry, sir.
To pour more money in this fund?
Yes.
Okay. So what do you think? Will it be a good investment now to buy the, okay, what mutual fund managers will do with the fresh funds now? Now, if they go for making investment in GP, will it be a good investment now?
I think.
Yeah, continue.
So price is high now compared to the previous year.
Yeah.
It may go down or in the coming days, it may not perform like this.
Okay. So now can we conclude that when the fund size becomes bigger for past good performance, nowadays fund has lower profit opportunities?
Yes, sir.
In that case, what is expected to happen if the fund alpha performs very well in previous year? Can we expect that alpha will perform very well in next year, or it will act in opposite direction?
It may act in opposite direction.
It may come down. It
Yes.
may come down. So that is the reason that when investors crowd in a particular fund, because of their outperformance in the previous year, it is not necessarily they will continue to outperform in the future years, because there might be lacking of the available profit opportunities. Okay. And it has also been found that in papers that when the fund receives more cash flow, it is the fund, they have received more cash flow because of their good performance in the fund. What do they do? Will they go for purchasing new securities, or they increase the existing holdings? What do you believe? What is more likely?
Existing holdings will be maybe more likely.
Okay. You see, they bought the GP at 237 in the previous year. Now, if they like to increase the existing holdings of GP now, at which price they have to increase the holdings?
346.
What will happen? Their average costing will come down or will go up?
Come down.
Average expenses will come down.
Come
for
down.
buying new holdings at a higher price?
No. Go up.
Go up. In that case, their alpha is expected to be a good number, or alpha is expected to underperform?
Underperform.
Alpha is expected to underperform. So that is the case. What happens when the people make much crowd in a particular fund because of their good past performance? So it is not always advisable to rush after the funds which have done very well in the previous years. Okay. So there the discussion what we are making are from several academic papers which have found the evidence of the attitude of the fund managers, what they do when they receive higher fund. So what we are discussing, what happened when the size goes up, what happened to the cost, what happened to the performance of the fund. And we have seen that performance may come down, cost may come down, but with respect to cost, if cost come down, performance may go up. But if you relate directly the size and performance, for several reasons, performance for cost decline, performance may go up, but for if size goes up, for the reasons what we have discussed, that is economies of scale, then unavailability of new profit opportunities may reduce the performance of the fund. Okay. Now, you have learned that I think many of you are present in the discussion session on understanding the stock market of Bangladesh held on last Saturday. What you have learned, how to pick the fund in a very short form, what has been suggested, which fund should be avoided. Which fund should be avoided? You are not present there? So one very shortcut suggestion was given, in addition to all the long explanation for how to detect the managers are not good or managers are kind of thief in not disclosing their holdings properly. So one of the ways that you need to check that how they have allocated their portfolio. In addition to that, how they are disclosing their portfolio. But other than this, how can you understand that a fund is a good fund? So for example, sometimes we see that if the fund manager has a very good experience for doing works in asset management industry, they are expected to outperform. And if the manager has a CFA or MBA, I mean the high educational credential, they are expected to outperform. Or if their age is higher because they are in the industry for long years, we expect that their alpha will be a bigger number. Can we expect like this? These are some qualitative attribute we may see, we might be interested to see before investing in a fund. Is it true? In addition to
Yes, sir.
the alpha, previous year's alpha or previous year's return, we also want to see this. Okay. So there has been a research by Chevalier and Ellison in 1999. What they wanted to see, is there any significant relation between the performance of manager characteristics. So how they have defined the manager characteristics? They have defined the manager characteristics in terms of their age. It is one variable. And another variable they have taken time in job. And another variable they have taken whether the manager had an MBA or not. And average SAT score or SAT score of the managers. In their average SAT score in their graduate schools. And they explored the relationship of these variables with the performance they are achieving. What do you expect? There should be a significant relation between these manager attributes with the performance of the funds. These are commonly suggested by advisors, that you look at the credentials of the manager and their experience before investing in a mutual fund, in addition to looking at their previous performance, previous alpha and corporate governance index, accounting disclosure index. You also want to see these variables. What do you expect? Just I am kind of, what is your hypothesis? Do you expect a significant positive relation between these variables and the performance, or you expect no relation, or you expect negative relation? Which one?
So positive relation.
You expect positive relation, but it has been found that there is no predictive power of these variables to predict the performance of the future performance of the mutual fund managers. But surprisingly, average set score, not from their graduate school, it has been found by the authors that average set score of the fund managers can predict the outperformance or underperformance of the mutual fund managers. Is it interesting?
Yes, sir.
Okay, so the thing is that it is not always advisable to go after those funds which performed very well in previous years. In addition to that, we also look at list of variables before investing in a particular mutual fund. So this is our discussion so far for the bond funds, which is our topic or the final topic. And there has been some discussion on hedge fund, which is out of our topic. But I would strongly encourage you to go through the hedge fund performance readings from your text for the sake of your curiosity, but for exam it will not be tested. So I would like to stop the